With the first half of 2015 behind us, it's time to take a look back to highlight key sales and use tax law developments occurring so far this year. On the cloud computing front, Vermont had legislation take effect on July 1st, repealing the state's cloud tax. The legislation, Senate Bill 138, provided that charges imposed for the right to access pre-written software remotely, also known as Software as a Service or SaaS, are not considered charges for tangible personal property, the sale of which would be subject to sales and use tax under Vermont law. Moving in the opposite direction was Tennessee, where, effective July 1st, Software as a Service became taxable under House Bill 644. Specifically, Tennessee continues to tax the retail sale, lease, licensing, or use of computer software in the state, but the legislation newly defined use of computer software to include the access and use of software that remains in the possession of the dealer who provides the software, or that remains in the possession of a third party on behalf of such a dealer. However, the legislation carved out a resale exemption for the purchase of software by a dealer who purchases it solely for purposes of reselling access to it and use of it. This resale exemption does not, however, apply to qualified data companies purchasing software for access and use by an affiliated company. Another jurisdiction, a local one, with a cloud tax to take effect was Chicago. Chicago's so-called cloud tax technically took effect on July 1st, with implementation originally slated for September 1st across the board. Tax rulings issued by the city's Department of Finance in June concerning amusement tax and personal property lease transaction tax cleared the way for the change. The rulings interpreted the city's municipal code as applying the city's 9% amusement tax to electronically delivered amusements, such as stream music or video, where the music or video is not permanently downloaded, and interpreted the code as applying the city's 9% lease tax, with some exceptions, to cloud computing, cloud services, hosted environments, and to software, platform, or infrastructure as a service. Though the municipal code calls for the amusement tax to be collected by the service provider and the lease tax to be collected by the provider in most instances, the department stated in the rulings that the issue of nexus as to whether a provider has a duty to collect the tax was beyond the scope of the rulings. Most recently in August, however, the city delayed the implementation date of the lease tax on cloud computing, cloud services, and the like until January 1st, 2016. Whether more cities across the country will follow suit in taxing cloud and stream transactions, and whether Chicago will carve out any exemptions, remains to be seen. To date, 2015 has seen multiple states enacting nexus legislation or having nexus legislation take effect. An Illinois click-through nexus provision, Senate Bill 352, that took effect at the start of 2015, specifies that the in-state referral involve promotional codes or other mechanisms, such as links on the in-state party's website, that allow an out-of-state retailer to track the resulting sales. Washington State enacted a click-through nexus provision scheduled to take effect on September 1st, and Michigan and Nevada have enacted click-through nexus provisions taking effect on October 1st. Tennessee and Ohio both enacted legislation containing click-through nexus provisions with July 1st effective dates. The Ohio legislation, House Bill 64, also provides that substantial nexus will no longer be presumed from a seller's registration or its licensure to do business in the state, or from any other contact with the state upon which substantial nexus is based pursuant to the Commerce Clause. The Ohio legislation also adds conditions from which substantial nexus would permit Ohio to require an out-of-state seller to collect use tax on sales made to Ohio customers, under conditions such as the use of employees or agents who sell a similar line of products or make use of similar trademarks or trade names as the out-of-state seller. Wisconsin had a change in its nexus provision that took effect on July 14th that includes within the definition of retailer engaged in business in this state, i.e. a retailer who would be obligated to collect tax, persons engaged in activities such as construction, the delivery of tangible personal property, and repair and installation services. However, some states failed to enact introduced nexus legislation. Louisiana, for example, saw an affiliate and click-through nexus bill, House Bill 555, vetoed by the governor in June. And Maryland and South Carolina both saw click-through provisions not be enacted. Finally, the Vermont Department of Taxes advised taxpayers that it will provide notice prior to enforcing the state's click-through nexus provision, which is scheduled to take effect under current law when at least 15 states have enacted click-through provisions similar to that of Vermont. On the online travel booking front, there were multiple legislative developments and court decisions to date this year concerning the collection of local sales and use or lodging taxes by online travel companies, or OTCs, also known as such names as hotel intermediaries and room resellers. In court decisions spanning the last decade, OTCs and local jurisdictions have often disagreed as to whether the OTC should collect the taxes on the higher retail rates they charge to customers for rooms or on the lower wholesale rate paid over to the hotels that excludes the OTC's markup. Rhode Island legislation, House Bill 5900, which took effect on July 1st, requires room resellers to collect sales and use taxes and hotel taxes on the higher retail rate, less any rental or fees the room reseller paid to the hotel. The bill requires room resellers to provide customers with an invoice itemizing the taxes and provides that the state's tax administrator will not issue an assessment against a room reseller's incorrect remittance of taxes or issue an assessment against a room reseller for a hotel's incorrect remittance. Ohio introduced similar legislation in April, House Bill 150, that calls for collection of tax on the retail rate and contains a similar hold harmless provision and invoice requirement. The hotel intermediary court cases to date this year showed no clear pattern on the issue of how transactions involving them and the sale of a room should be taxed. For example, the District of Columbia Court of Appeals in Expedia Incorporated versus District of Columbia held in July that OTCs were liable for sales tax on the retail rate, but not on the sales tax reimbursement that the OTCs pass on to the hotels, because under the DC Code, the taxable sales price excludes such amounts. The Florida Supreme Court in Alachua County versus Expedia Incorporated held in June that the local option tourist development tax applies to the lower wholesale rate received by the hotel, while the Hawaii Supreme Court in March held in Travelocity.com versus Hawaii Director of Taxation that the OTCs were liable for the general excise tax, a privilege tax, on their gross income from the room sales because they had sufficient business activities in the state. However, in interpreting statutory language and legislative intent, the Hawaii court held that the OTCs were not liable for the transient accommodations tax imposed on gross income because they did not actually furnish the rooms like the hotels do. In so holding, the court declined to impose the transient accommodations tax twice, once on the OTCs on the retail rate and once on the hotel on the wholesale rate. Following this March decision, the Hawaii court denied the Hawaii Director of Taxation's motion for reconsideration. Two emerging sales taxation areas involved rideshare services, such as Craigslist Rideshare, and crowdfunding platforms, such as GoFundMe and Kickstarter. With respect to crowdfunding transactions, where donors back projects online and sometimes receive a reward in return, a couple of departments of revenue have recently provided guidance on how they tax these transactions. The New Jersey Division of Taxation issued such guidance in April, advising taxpayers that such donations are not subject to sales and use tax, even if the project creator agrees to provide the donor with tangible personal property at a later date. Project creators, however, may be liable for sales or use tax on the property they give to their donors. Conversely, in guidance issued by the Washington Department of Revenue at the end of 2014, the department stated that the project creator must collect sales tax on donations if they provide retail services, digital products, or tangible personal property as rewards. With respect to rideshare transactions, where the sharing of rides is arranged, in contrast to network transportation services provided by companies like Uber, Georgia enacted legislation this year, House Bill 225, which creates a one-year sales and use tax exemption taking effect July 1, 2016, which exempts fares of for-hire vehicles for which a rideshare network service has purchased a for-hire master license. Moving in the other direction was Pennsylvania, which enacted legislation to limit a sales tax exemption on the books for rideshare drivers. The legislation, House Bill 140, which took effect on August 9th, amended the sales tax exemption for payments that rideshare drivers receive by stipulating that in order for a rideshare driver to qualify for the exemption, they cannot be engaged in transportation as a business. In the coming years, it will be interesting to see if jurisdictions move to enact legislation or issue departmental guidance specifically addressing crowdfunding and rideshare transactions, as has been the case with other newer types of transactions, from virtual currency to legalized marijuana to streamed entertainment. The first part of 2015 saw the introduction of multiple pieces of federal legislation aimed at evening the playing field between online retailers and bricks-and-mortar businesses with regard to sales tax collection obligations. The Marketplace Fairness Act of 2015, Senate Bill 698, introduced in March, and the Remote Transactions Parity Act of 2015, House Resolution 2775, introduced in June. A past measure with similar intent was the failed Marketplace Fairness Act of 2013. The 2013 Act authorized member states of the Streamlined Sales and Use Tax Agreement to require those sellers who did not qualify for the small seller exception to collect and remit sales and use tax on the remote sales they made. The 2013 Act also permitted states that were not members of the SST agreement to collect and remit sales and use tax if they adopted minimum simplification requirements and met criteria such as implementing a uniform sourcing rule for remote sales, having a single state entity administer both state and local sales and use taxes, including audits, and providing sales tax calculation software for remote sellers. The 2015 Marketplace Fairness Act differs from the 2013 Act in that it specifies that a state cannot begin to collect sales and use tax on remote sales until 1 year after the enactment of the Act and during the last quarter of the first calendar year beginning after the Act's enactment date. Similarly, the Remote Transactions Parity Act of 2015 has a stated intent to give states, both SST members and non-SST members, authority to enforce state and local sales and use tax laws on remote sales. The Act contains a similar delayed implementation clause, shows some variation in minimum simplification requirements when compared to the Marketplace Acts, and contains limitations with respect to the audit of remote sellers, like not auditing remote sellers whose gross annual receipts are less than $5 million in the taxable year. The Act also specifies that in the event of an audit, a remote seller has the option of having its certified service provider, or CSP, contacted first, furnish the state with transaction records, and represent the remote seller during the audit. Finally, the Act contains requirements for states related to CSPs, such as providing certification procedures for persons to be approved as CSPs, not denying or revoking certification to a software provider absent reasonable cause, providing compensation for CSPs, and having more than one national CSP certified at one time. Whether federal legislation will be enacted to increase states' authority to require tax collection on remote sales remains to be seen, as retailers across the country keep a close eye on developments in this area. Bernita, Ferdinand, Wolters, Kluwer, Chicago.